Hi, everybody. This is Buck Joffrey. I am the host of Wealth Formula Podcast. And today I want to talk to you about a very interesting asset class that I want to teach you about. And the title of this talk is Life Settlement Investing, the Ultimate Hedge. And I think you're going to enjoy it. Now, a little bit about me. Again, my name is Buck Joffrey. I am a physician by training. I'm a board certified head and neck surgeon. I also have started a few different businesses, and therefore I can qualify myself as a serial entrepreneur. And during that time, I had the opportunity to make a fair amount of money and got interested in investing. And so mostly that's what I do right now. I am retired as a physician. So part of what I do is I would consider myself sort of a professional investor. And I'm also an educator. And I focus on teaching people who make a lot of money, high-paid professionals specifically. I'm not talking about hedge fund managers. I'm talking about accountants and engineers and doctors, six-figure folks who don't have a lot of time to think about how to invest, who are just focusing on their day jobs, and they make a lot of money, and they're trying to figure out how to grow it and create wealth. And I talk about that mostly on my show, Wealth Formula Podcasts, which you can download at wealthformula.com. You can also get it on iTunes and Stitcher if you're familiar with those as well. Now, my perspective on investing is a little bit different from what you probably hear on TV, or if you hear people like Susie Orman or Dave Ramsey, or really anybody talking about traditional investing, because my perspective is different. I'm a child of an immigrant entrepreneur who was never taught about stocks, bonds, and mutual funds, and he was never taught about it, and so he never taught me about it. In fact, my dad is the one who I'm talking about, the child of an immigrant, and he came from nothing. He came from India in the 1967. I wasn't born until 1973, and he came here. He was very poor in India, and as you may know, if you're poor in India, that means you are really poor, folks. At any rate, he came here with nothing except, he's a smart guy. He came here on a scholarship as an engineer. Pretty quickly got interested in real estate investing because it made a lot of sense for him. And so he went on to become a real estate investor and ultimately lived the American dream. He became a millionaire in the U.S. My dad's influence, along with this guy who you see in the photo, that's Robert Kiyosaki, made me see the world a little bit different from the rest of my physician colleagues, and that's why I can credit my ability to retire at the age of 43. Now, just for perspective, I didn't finish my surgical training until I was 34, almost 35. So folks, this is something that happened pretty quickly, and that's why I'm so excited to share what I know with everyone else. Now, I talked about Robert Kiyosaki there. By the way, that was his 70th birthday party, and I'm a huge Robert Kiyosaki fan. He is the #1 best-selling financial author of all time. And I also happen to have a book that was an Amazon #1 bestseller called The 7 Secrets of Eternal Wealth. And really what this focuses on is the idea that investment paradigms that you are being fed every day by Wall Street are probably, at this point in time, a little unsafe, and that there's a high risk and of dying broke if you simply do whatever your wealth advisor says. And that is true even if you make a lot of money in your day job. It's simply math, and you'll understand more about that if you actually get that book, which you can, by the way, you can download the PDF for free at wealthformula.com and do that. Now, listen, your wealth advisor might be a nice person, and there's nothing, I'm not saying that these are bad people, but the way they are trained, ultimately, they are minions of Wall Street, and their interests frequently are not aligned with yours. Now, look at this graph, right? Because this is sort of fundamentally what you hear from the wealth advisors all the time, because they want you to believe this. It is this graph is labeled the power of compounding interest. And it is incredibly powerful, folks. What is compounding interest? So some of you probably don't know it. You just know that everybody says it's magical. Well, it's really quite simple. What compounding interest simply is that when you take an investment, say you invested $1,000 and you made 8 or 9% on that, or 10% in over a year, and all of a sudden instead of $1,000 you have $1,100. So now you're not only investing what you initially invested, which was $1,000, but you're investing it back with the additional $100. So now you're investing $1,100 instead. And if you keep doing that over time, you get this steep curve in the growth of your money. And that, my friends, is the power of compounding interest. And I don't argue with that. But if it were that simple, becoming wealthy would be very easy, right? The magic of compounding interest only works when the trajectory is always up. And that's what we don't hear about from the wealth advisors when they talk about the magic of compounding interest. In fact, this is actually what it looked like in 1987 with the major stock crash. Now, a lot of you might not be old enough to have experienced that. I was still, I think, in middle school at the time, so it didn't affect me very much. This one did affect me. This one happened in the late 90s, early 2000s, and this is the dot-com bubble. And again, some of you probably remember that everybody was becoming a millionaire. My wife was in San Francisco at this time and just out of Stanford. And boy, there was millionaire 20-year-olds everywhere running around, and the stock market was drinking the Kool-Aid. Everybody was making tons of money. Even my dad, who was a real estate investor his entire life and made money that way, looked around and he saw everybody becoming millionaires, and he sold off a bunch of real estate and invested it into tech stocks. Well, guess what happened? He almost lost everything on this one. And that's my experience with investing in stocks, bonds, and mutual funds. And again, this happened in 2008. Now, this probably might, there's a lot of you who are listening to this, that this affected you. This affected you, or it affected your parents, and you saw it in real time. I can tell you that's when I finished my residency, right around 2008, and the people I started working with, and I was around in 2009, I just saw some of these people who'd been invested for decades and were ready to retire, and all of a sudden 40% of the portfolio was just gone. Now, listen, even if that was you, maybe you didn't lose that much, but when this happened, how did that make you feel? And how do you know it won't happen again? And how do you know it won't happen just as you want to retire? And if it does, what are you going to do? Listen, we talked about 1987, 1999, 2008. Seems like every decade there's something devastating happening, but we always come back. Why is that? Because we are told that we're supposed to invest in stocks, bonds, and mutual funds for the long term, and that these equity markets, they're like nature. They happen and you can't avoid it. Well, I don't think that that's true, folks. I think you can avoid it. And there are lots of ways we talk about that on my show, and lots of ways I talk about that in my book. And by the way, if it happens every decade or so, like I said, 87, 99, 2008, well, as of today, it is 2017. We might be due for something pretty soon, don't you think? Now, again, let's talk about retirement. And if you haven't figured out by now, you understand, I don't believe in stocks, bonds, and mutual funds as a way of securing your golden years. Listen, investing for your golden years needs to be more secure. It needs to be something you feel like is almost guaranteed. Now, that's a problem in investing. In general, that's a big problem. And I can tell you, and no matter what you invest in, for the most part, it's never a guarantee, right? In fact, Ben Franklin said it best. He said, "Nothing can be said to be certain except death and taxes." Now, I will argue with the taxes part, and if you listen to my show again, you'll hear or read anything that I write, you'll see that there are lots of ways to legally not pay taxes. But but there's no way to get away from death. And remember, I'm a physician, so I can tell you that there's only one way out of this place, folks. That is really the only guarantee in life. But what if you could invest in the only guarantee in life, invest in something that was backed by death. Well, you can, and it's called a life settlement. So you see, in 1911, there was a Supreme Court case called Grigsby versus Russell. Now, this is really interesting stuff, right? There was this guy named John C. Burchard, and he needed surgery, and he couldn't afford it. And he also couldn't afford to pay premiums on his life insurance policy anymore, and his premium was overdue. So what he did is he offered the surgeon, Dr. Grigsby, his policy. And he offered him a policy for $100 and for surgery. So it was a fair trade. Dr. Grigsby thought so, at least. And he accepted that offer, and both the patient and the surgeon came out with something of value. Well, when Mr. Burchard died, of course, then the surgeon went and tried to collect his insurance money from the death benefit. And his insurance company, of course, tried to block paying the surgeon. But guess what? They lost. The Supreme Court ruled back in 1911 that life insurance policies are assets, just like real estate, just like anything else that you own, that you can say is yours. And just like that, it can be assigned, it can be sold, whatever. And that is a life settlement. So here is a scenario, right? Because right now you're thinking, well, this is a little morbid, but I want to make sure that you understand this is not morbid at all, folks. This is helping people. This is making money and helping people. So let's look at the scenario of your typical person who might be in a position where they might want to sell a life insurance policy. The scenario is that of an 82-year-old man who's been paying on a $1 million life insurance policy for 35 years. Now, if you know a little bit about whole life insurance policies or universal, what we call permanent life insurance policies, that over time, they accrue what's called a cash value. It means it's how much, value there is actually that's liquid if you wanted to, borrow it, or if you wanted to, to invest it into something, so on and so forth. That is called the cash value. So in this case, the cash value has grown to about $100,000 after 35 years. And let's say that in this situation, this 82-year-old person who's been paying on that policy all of a sudden can't afford the life insurance premiums anymore. But he still needs money to live because he's invested in stocks, bonds, and mutual funds. All right, that's a shot. But my point is, so now this person needs money to live. What are their options? Well, one option is they can simply let the policy lapse. And in that scenario, of course, the insurance company wins. They've collected premiums for years, for decades. And then they will never have to pay out a death benefit, right? It's total win-win situation there for the insurance policy. And this is terrible because nobody, the senior in this situation is a big loser because unfortunately they have paid all these years and they're going to get nothing in return. Their heirs are going to get nothing in return. This happens a lot, folks. And, over half of life insurance policies go ultimately lapse because of lack of payment. And in 2008, there's a statistic that $112 billion of death benefits were forfeited by seniors over the age of 65 by letting insurance policies lapse. So there's another option. Of course, we talked about what a cash value is. And if the senior knows that they can do this, they can call up the insurance company and say, hey, I know I've been paying for 30 years, but I can't afford it anymore. Can I just have that $100,000 and then we call it even? That way you don't have to pay that $1 million when I die. Well, the insurance company is all over that. They totally win in that scenario. Again, the death benefit usually is so much higher than the cash value that they're going to take this deal any day. After all, the insurance company will never have to pay out the death benefit despite decades of premium payments. Now, there's a third option. Now, this is a great option for the senior, right? So the senior needs money, or he or she might not be able to even pay the premium the premium for the policy, and it's going to expire anyway, right? Or maybe they just have too much insurance. So they want to get rid of it, and they want to use some of that money while they're living, right? So in this option, the senior sells the insurance policy to a third party, and then that policy becomes known as a life settlement. Well, what happens here? The senior wins. The third party pays out typically 4 to 5 times the cash value. So we said the cash value before was about $100,000. Now we're at about $400,000 or $500,000, right? Of course, the senior is going to love that. And the investor wins. Why? Because the purchase, even though you're paying 4 to 5 times as much as the cash value, it's still substantially discounted compared to the death benefit. And who loses? Well, the insurance company loses. Listen, folks, I don't have a problem with insurance companies. These are great companies. But what I will tell you is I'm not going to shed a tear because they make tons of money. And they're going to have to pay out a death benefit because that's the contract they signed when they started this thing. And so in that scenario, folks, the investor wins. Hopefully you're the investor. The senior wins and the insurance company loses. Now, if you're a senior in this situation, put yourself in that situation because a lot of people, again, think of this as a morbid thing, right? But wouldn't you love to be able to liquidate something that you own if you had to do it? It seems only fair. In fact, there was a survey in 2010 of people who let their policies lapse. And 90% of them said they would have considered selling their policy if they just knew it was an option. So who invests in life settlements? I mean, obviously, a lot of you might not know about this, and you might be wondering, well, if this is so great, if the ability to get exposure to this asset class is so great, why don't I know about it? Well, because it hasn't really been available to retail investors like the mom and pop investors until fairly recently, but who it has been available to and who has been heavily invested in this stuff. Institutional money, hedge funds, multinational banks. Warren Buffett, through Berkshire Hathaway, invests $600 million per year buying life settlements. Bill Gates has a $500 million position in life settlements. Why? Because insurance companies pay out. They do. I mean, I got an insurance certificate, so I'm a licensed insurance person. And I don't sell insurance, but I wanted to learn about this stuff because I find it incredibly fascinating. I was really fascinated by this whole life settlement industry. And what I found out was pretty amazing. These insurance companies have to pay out, even in suicide. After 2 years, somebody has a policy. There's pretty much no way they can renege on a policy, even if there's some fraud involved. They still have to pay out. Insurance companies are also some of the biggest, oldest, most profitable companies in the world. I have to tell you, when I have a type of whole life insurance policy that we call wealth formula banking. You can, by the way, if you're interested in knowing more about that, there's a whole section on wealthformula.com about that, or you can go to wealthformulabanking.com. But bottom line is, I wanted to try to understand a little bit about, how stable these banks are. They talk about dividends, not banks, insurance companies, how stable the insurance companies are. Do they pay out dividends, et cetera? And I asked the company, you have these dividends and you say they are, they're pretty much always paid, but they're not guaranteed. So how guaranteed are they, or how often do they pay out? Well, the company that I got my policy through has paid dividends out every year since the Civil War. Okay, that's stable. Think of all the bank failures and equity market disasters and everything where people lost money in these situations. Well, these companies have paid out dividends, profits throughout this entire time. That's very, very strong and powerful, folks. Now, again, that's another reason why people like Warren Buffett invest in insurance companies. Another reason, well, in terms of life insurance, death, again, is a guarantee, whereas I did say taxes are not. So I don't entirely agree with Ben Franklin, but death is a guarantee. And life expectancy, in general, is highly predictable on a large scale. And finally, and this is what I'm getting at with a lot of this for you and why I showed you those graphs, death is not correlated with the equity markets or the economy. And if anything, when the economy tanks, death rates rise. So like any asset class, there are risks involved within, investing in this asset class or getting exposure to it. And the biggest theoretical risk, frankly, is simply longevity, right? Once a policy is purchased, the longer the policy that you bought, the lower the annualized return. So, 60% return over 3 years, you might buy a policy that has a total return of 60%. Now, in 3 years, that might be down to 20%. If in 3 years, that might pay out, 20% annualized. Well, if a person lives a certain period of time, so say now they're living 6 years, well, now it might be down to 10%. So the whole idea is that it's all a numbers game. The other issue is that you have to pay yearly premiums. I mean, this is still a live insurance policy, so it can't go unpaid. So there are strategies for risk mitigation for investors. First of all, certainly I believe that investing in a fund of individual policies or having exposure to a fund of individual policies is a lot more stable than investing in individual policies. Then it's a situation, if you're investing in just one policy, then you're just kind of like, okay, well, when is this person going to die? Well, at least if you have several policies in a fund, you've got more portfolio theory. And so that takes out some of the aberrations. Obviously, you have to choose your policies carefully. Life expectancy in the U.S. all in is about 78 years old, right? So probably shouldn't be picking a bunch of policies of people who are in their 60s or 50s. There are, the use of multiple independent actuarial studies is also really important. Actuarial studies can be incredibly powerful and accurate, and they're even more powerful and accurate if you pool them and you average out those results. And finally, if you invest in a fund, it's a good idea to look at a fund that has some kind of system of pooled escrow and reserves for those policy payments. Because again, your biggest risk, is longevity. So if there's a way to mitigate that risk, that is going to be a better way to go. And there certainly are great ways to do that. So who's selling these policies? Well, a lot of people want to get a sense for that, especially a lot of my doctor listeners and people, parts of my investor group. So this is a real patient I'm going to go through. Now, this is an 83-year-old man with a history of what's called coronary artery disease, and also who had a pulmonary embolism 1 year before with stents implanted. Now, a lot of you doctors, again, out there know what this stuff is, but for those of you who don't, first of all, let's go through that line. 83.3 years old, that's already above, the average life expectancy of a man. Has a history of coronary artery disease. What that means is the arteries of the heart. Now, when those things get clogged, you get something called a myocardial infarction, otherwise known as a heart attack. So this person has narrowing of those blood vessels. He also has a problem with the blood vessels that lead to his lungs, the pulmonary arteries. In fact, this person has had what's called a pulmonary embolism, which means literally some clots got stuck in there. And that's really bad. You can die very, very quickly when that happens. And in fact, this was bad enough where they put in stents to pry open those blood vessels. So none of this is good, okay? Now, this person also has a history of multiple falls in the last 5 years, suffers from recurring dizziness and vertigo. And that probably is one of the reasons why this person has had so many falls in the last 5 years. Now, I should point out, for those of you who are doctors, you know this, but when you fall and you break your hip, there's about a 50% chance of dying during the hospitalization of breaking your hip. So again, you look at this and you're like, oh boy, this is problematic. This person also has a history of smoking. I don't have to tell you that smoking is bad for you. A history of alcohol abuse, and was recently hospitalized for an increase in shortness of breath. He is on medications right now for high blood pressure, for acid reflux. Hydromorphone is for pain. We don't know why. There's some sort of chronic pain going on. And Coumadin, which is the most potent blood thinner known to man. By the way, now you fall, not only can you break your hip, but if you're on Coumadin, you can have a bleed out in your brain. This is somebody who's not in good shape. And so when I do this presentation live and I have doctors in the audience, this is usually when I ask, what is this person's life expectancy? And so usually what I hear is 2 years, 3 years, things like that. That's what usually happens from the doctors. Now, this is what the actuary, what the actual, policy details are. And let's go through that. This is really important. So there's some details up here. Basically, you're looking at the insurance company, the company rating. It's an A-rated company. You can see the face amount, etc. Now let's go down to here it says longest LE and average LE. Now LE is life expectancy. So this is life expectancy in this situation was put together, projected by actuarial studies. So average life expectancy, average LE, is telling you that of all the actuarial studies, they took the average number of months they thought this person would be alive and divided it up and got the average of 64 months. Okay. To me, that seems a little long, but that's I'm a physician. These are actuarial studies. The longest actuarial study actually showed up to 75 months. So that's the outlier. Right? I mean, that to me sounds really long, but there's at least the one actuarial study that's projecting up to 75 months. Now let's look how this all comes out. Now, this is where it gets really cool. So look at the estimated return, including premium refund calls. You see that at the bottom here. And when you go across, basically what this is telling you is that every year that this person's alive, if they pass away during that year, what the internal rate of return is for the investor. So at year one, if the person dies in the first year, basically you double your money and then some. You're at 106.56%. If this person dies in the second year after buying this policy, 42.45%, and so on. Now, the average life expectancy here was 64 months, which is right around 5 years, right? So if this person dies around 5 years, the return from this policy is still 15%. And now if you go all the way down to the longest life expectancy on those actuarial studies, you're still pretty much in double-digit returns in terms of internal rate of return. Now, of course, if this person ends up going into their 90s, you're down to, not a lot of return here. But that's the idea, and that's the idea behind a life settlement. And you can also understand why it might be important or useful to invest in not just one of these, but in several of these, because then you're just leveraging, again, the whole idea of portfolio theory. Because let's say now instead of, let's say instead of that one person, you have 7 people who have the identical profiles of that person I showed before, because basically that's really what, the way these things look. Now, in that scenario, I always ask the doctors in the group, the same doctors in the group who say that this, they thought that guy would die in 3 years or 4 years, who would bet that if there was 7 of them that looked exactly the same, that at least one would pass away earlier than the 64 months that was projected by the actuarial study. And virtually everybody, even the non-physicians at that point, will guess that at least one of those people would die. And then when I asked them when they would guess the first person would expire, they'd say 1 year, 2 years, etc. Well, I was conservative, right? And I'm still a physician, but I said, well, okay, well, maybe it's 36 months. So let's say, again, you have this fund and one person expires at 36 months and you have one person expire at 75 months, which is late. And then there was 5 other people in this fund that expired right on time, right at that 64 months that was projected by the average life expectancy. Well, if that happened, at the end of this fund, the internal rate of return for this fund would be about 13.12%. Now, internal rate of return is a little bit hard to understand because it takes into consideration something called the time value of money. And I don't want to get into that too much, but I've also given you numbers here that are called annualized return, which in my view are much easier to understand. So here's how annualized return works. Say you invested $100,000 into something, and at year 5, you made $100,000, and so your total amount, you basically doubled your money in 5 years. What you do is you divide that $100,000 that you made, divide it by the number of years it took you to get there, and that gives you an annualized return. So in that scenario I gave you, that would have been a 20% annualized return, right? So that's how annualized return works. Anyway, in this scenario, the annualized return, if one person died early, one person died late, 5 people died on just as projected by the actuarial study, would be 16%. So a $100,000 investment, would become over $200,000 after 75 months. And again, this is from investing in the fund one time and letting it stake its course. I'm not talking about reinvesting any of that money, right? We talked about what compounding interest is. I'm not using any of that. I'm just saying money that comes off every time somebody dies. This is where where you would end up with in this theoretical fund, 16%. Now, if you did use a reinvesting strategy, just the way you do in that whole, with the magic of compounding interest, things change dramatically. Now, one of the things, again, when you look back at that same graph that you have, is you see that when people die early, you get these huge returns, 106.56 in the first year, etc. And then even in year 3, you're getting a 26.43% return. So if somebody dies early and you reinvest that quickly, that money can multiply very, very quickly because of that whole compounding interest thing. And that's what happens when you look at this from a very, very different perspective, or what can happen. I won't ever guarantee anything, but it stands to reason, right? If now every time somebody passes away, you reinvest that money into another fund where there's more people who look exactly the same or very similar, who are octogenarians with multiple health problems. Now you can create a scenario where it becomes much more realistic to see your money grow in a curve similar to this. Again, that's all compounding interest is. It is reinvesting quickly. So again, reinvestment results in a compounding effect that could theoretically amplify your return significantly. So let's say I'm going to go back to this whole theoretical thing again. Now, if we reinvest every time there was a distribution in the scenario that we gave early, right? So with those 7 people, say we reinvested every time one of those 7 people died, we reinvested into another fund, and that fund looked the same way that the previous fund did, which most of them do. They look fairly similar, right? Now, what would happen in this situation is that in about 14 and a half years, you would end up with an internal rate of return of 15.01%. And the annualized return, again, that's easier for me to remember, becomes 28.5%. That's literally like thinking that, if you had $100,000 into this thing, every year over that 14 years, you'd be making 28.5%. And in this theoretical model, what would happen would be that $100,000 investment in an IRA would turn into over $500,000 in 14 and a half years. Again, all I'm doing is using the magic of compounding interest. So I'm not, and it's theoretical, but I'm trying to explain something that's really important. That concept works great if you can have some surety that there will be a payoff. And frankly, I think death is a pretty, is pretty sure thing, right? So again, remember, all these numbers are theoretical. No one knows for sure when people are going to die, and life expectancy will go up over time. That changes in life expectancy, though, will likely impact children and younger people, maybe people even in their 40s and 50s and 60s, more than they're going to impact people who are already in their 80s who've got multiple health problems. The damage there has already been done, and that's why we buy life settlements of those folks. And also remember that even though that we think, life expectancy will go up, for the first time since the 1990s, life expectancy numbers from 2015 compared to 2014 actually dropped. And listen, here's the thing. Even when life expectancies go up, actuarial studies will change over time accordingly. These insurance companies are way too smart for that not to happen. But here's the thing. And this is what I want you to remember and why I think this whole strategy is so powerful. Death is the only guarantee in life, and life settlements pay out when people die. Now, if you're interested in learning more about this asset class, make sure that you fill out the form on this page and submit it. Now, to get exposure to this asset class, you don't have to be Bill Gates, you don't have to be Warren Buffett or a hedge fund manager, but you do need to be an accredited investor. Now, what is an accredited investor? It's not something you apply for. It's something that you either are or you are not. You are an accredited investor if you make $200,000 per year in income, or $300,000 per year if you're filing jointly, or you have a net worth of $1 million outside of your personal residence. And if you meet that criteria, then you can potentially get exposure to this kind of asset. Now, finally, a summary. Life settlements, folks, are a little-known asset class utilized by institutions and the ultra-wealthy, and now they might be available to you. They provide really notable returns considering the risk profile. And again, these things are guaranteed by death. They are uncorrelated with the equity markets and the economy. This is critically important as you plan for your future. And finally, they act as a very, very attractive hedge to just about any portfolio. Now, if you have any questions about this specifically, feel free to reach out, buck@wealthformula.com. Otherwise, go ahead and fill out the form, submit it, and we can have a conversation a little bit more, and I can answer all your questions. Thanks for listening.